Okay, so we're pretty much finished with our chapter in mutual funds. It's a very simple chapter, a lot of definitions and concepts and stuff like that, but it's important that you guys read it. So now I want to talk about hedge funds briefly. What is a hedge fund? A hedge fund is very similar to a mutual fund, except that a hedge fund is actually for wealthier individuals, individuals that usually have more than $1 million in net worth. Hedge funds are actually to take on more risk and to engage in risky activities. So hedge funds, the name is actually a misnomer because a hedge is actually to reduce risk. But in this case, a hedge fund is actually to take on risk. So hedge funds are to take on risk. Wealthy individuals put their money in there. They're lightly regulated, very different than mutual funds, which are, much more regulated. Mutual funds are for, regular, typical investors, whereas hedge funds are for rich investors, and there's a lot less regulation. So that's kind of like the major differences between a mutual fund and a hedge fund. And hedge funds usually have higher fees, higher management fees, because supposedly you have these managers that do really, really well, are supposed to generate high returns, engaging in these high risky activities. So let's quickly look at the definition of a hedge fund. All right, so Investopedia always gives us some interesting definitions. For informal uses, you can always look at Investopedia. If you need, more formal definitions, then, depending on what you're doing, you might want to, look at more, reputable sources. So what is a hedge fund? Hedge funds are alternative investments using pooled funds that employ numerous different strategies to earn active return or alpha for their investors. Hedge funds may be aggressively managed or make use of derivatives and leverage in both domestic and international markets with the goal of generating higher returns. It's important to note that hedge funds are generally only accessible to accredited investors as they require less SEC regulations than other funds. So accredited investors basically means wealthy investors, okay? Rich investors. So supposedly the rich folks are supposed to know more than, your typical investor, so there's less regulation. So it says that they seek different strategies to earn alpha. And remember, if you remember, alpha comes from the CAPM, right? So alpha is a type of overperformance. Investors are trying to seek an overperformance. They're trying to identify cheap stocks where they can make greater returns than what they're supposed to. So they want to generate these large returns that are not justified by the amount of risk that they took. That's what the positive alpha is. And these portfolio managers or these hedge fund managers are going to use derivatives, and they're going to be highly leveraged to get these large returns. So that's pretty much a hedge fund. Now, in the financial crisis, a lot of hedge fund managers ran into trouble. Of course, Bernie Madoff is one of the most notable figures for running this large Ponzi scheme. Also, Stanford, I believe, was also one of these guys that had some kind of Ponzi scheme going on with his hedge fund. So hedge funds, they're not as regulated, so it's a little bit it's a riskier investment. And then they're sorry about that, guys. So that's a hedge fund. If you have any more questions, we can talk about it during class. This is the mutual fund chapter, straightforward chapter. Take a look at mutual funds. Just to recap, mutual funds, pooled investments, to help people manage money. Then you have exchange traded funds, which are similar to mutual funds, but they're traded on exchange and they're a lot more flexible. And you can trade them very often. One thing that I didn't, show you guys with mutual funds, and I wanted to finish, showing you guys this is, let me quickly look at, So you have like industry ETFs. So look at this. Look at this. So here's an ETF list of industries, right? So you can get an ETF that's in the financial services industry. For example, Fidelity MSCI Financials Index ETF. Okay, so this ETF will invest only in financial companies. All right, so basically you have a portfolio of financial companies. You can get another ETF that is in a different industry. Maybe you want natural resources. Okay, for example, maybe energy, oil and gas. So these ETFs right here, for example, this one, IQ Global Oil Small Cap ETF, will invest only in oil companies that are small companies. All right, so you have a portfolio of small oil companies, all just by buying one ETF. So as you can see, there's a lot of diversification, or a lot of, I guess not diversification, a lot of variety in ETFs. They also have what they call leveraged ETFs, okay? And these leveraged ETFs are very cool because they give you 2 or 3 times the returns that a regular investment would give you, right? So, for example, this one right here. Taking a little bit. This Ultra S&P 500 ETF means that it's going to give you twice the return of the regular S&P 500. So earlier I showed you the SPY, which was the regular ETF S&P 500. Now this Ultra will give you twice the return, meaning that if the regular S&P gets 1% return in a day, this will give you 2% in a day. Now the same thing happens if there's a loss. If you get 1% loss in the day, then the Ultra will give you 2% loss in the day. So these are leveraged ETFs. They give you 2 or 3 times the return of the underlying asset. So it's a very, very easy way to leverage yourself, but they're high risk, and usually these are more for short-term investments. And then you can do short ETFs, meaning that if the S&P 500 goes up by 1%, then your ETF will go down 1%. So it'll do exactly the opposite of whatever the investment is. So these are the short ETFs. So take a look at them. They're very interesting. But that summarizes pretty much this chapter. We talked about mutual funds, we talked about exchange-traded funds, and then we talked a little bit about hedge funds. If you have any questions or anything, guys, just let me know. We can talk about it in class. I'll be more than happy to elaborate even further on this. All right, thanks, guys.